Hi, I'm Natalie Cook. I'm the CEO and owner of Finance Fight Club. I'm here to make finance simple for you to understand as a small business owner so that you can fight for your financial future. Today, we're going to talk about something that is very controversial in the tax and CFO and bookkeeping space. And I would love comments on this video because I think that I might ruffle some feathers. So that is, what is an S-corp and should you become an S-corp? So before we even get there, let's talk entities. I am not an expert in this. This is not tax advice. I am not a tax preparer, nor am I a tax strategist. I know enough to be dangerous and then refer you to the experts. So this video is in no way giving you tax advice. Do not follow it for any tax advice. Do not send it to a tax preparer and say, hey, this person told me X, Y, and Z. Do this. Ask their opinion. Get multiple opinions. But I'm going to tell you my opinion on this with that disclaimer. So what I see happening in this LLC business startup space, if you're not going to go VC route, is, hey, I'm going to open an LLC and then I'm going to become an S-corp because it's the best. It's what everybody's telling me to do. And I'm going to tell you, don't do that. It's a silly idea for a lot of reasons. There's a good point at time in which an S-corp makes sense, but not always. And I'm going to talk about a little bit about that. We'll also talk a little bit about the C-corp. And again, I am not the expert on this. This is experience that I have had with talking to brand new entity business owners and then seeing a lot of business owners make that switch and the challenges that come along with it. So to clarify, and when you start a company, you choose an entity type and you can be a sole proprietor, you can be an LLC, you can be a C Corp. I feel like there's a couple others, like if you're a medical company, there's a PLLC and there's some other things. Most people, when they start, they become a sole proprietor or an LLC. A lot of times when you're building a business partnership, you build that as an LLC. An S Corp is not an actual entity. It is a tax filing status. So you're saying, hey, I am a Washington State LLC, federal government, please tax me as an S Corp. You can also choose a C Corp election as well. You can also be a C Corp. I don't know why that makes any sense. It's very confusing, but I think that's a key distinction for this conversation is that an S Corp is not an entity. It's an election that you choose at a future point in time, and it's a way of being taxed. I'm not going to get into the benefits of that specifically of all the intricacies. We're going to talk about the one that everybody talks about, and I'm going to tell you why I don't think that's awesome all the time. So a lot of times people will become an LLC and then their tax person will be like, you're going to save so much on taxes if you elect to become an S-corp. Now, the reason for that is when you are an LLC, whether a partnership or closely held company or a single member LLC, you're taxed on the profits of the company on your personal tax return in April on all of the profits of the company. So whether you got that cash or not, if your business made $80,000, you are going to pay taxes on that $80,000 or your chunk of that $80,000 if there's multiple partners in April. That's how it works. Or you're going to pay quarterly taxes, which you should do. Sometimes if it's under a certain amount, you can get away without paying quarterly or you can pay the penalties. So ideally, that's what people do. And then the tax people come in and they say, hey, you should elect an S-corp. Now, what they're saying is when you are an S-corp and you are an owner of an S-corp, you can put yourself on a W-2 salary. And so that's saying, hey, I made $80,000 last year. I'm going to put myself on a W-2 salary. And then you can choose a salary that is commensurate with your function in that company, and you can save on payroll taxes only or self-employment taxes only. So you're saving a chunk of taxes here with that salary, but you have to pay yourself, you're supposed to pay yourself a regular W-2 salary. Some people can fudge it and they can do it at the end of the year. There's lots of tax people that will do some funky stuff. I don't understand all of that. But from my perspective as the CFO, if you're going to do that, you need to be able to pay yourself on a regular W-2 throughout that year. And you're still going to be paying yourself owner's draws. So a lot of tax preparers have some strategies around that. Go talk to them about that. Usually it's like, hey, we're going to put 40% or 60% into your W-2, and then the alternative is going to come out in owner's draws, and that's going to save you on that payroll tax piece. And yes, I think if you are pulling around $80,000 to $150,000 out of your business every year in cash, and reporting that to the government, and then you're switching to an S-corp, you will save on taxes. That's not untrue. So I'm not saying that's untrue. But the things where people run into issues and they become an S-corp too soon is they don't actually have the cash flow to do those regular W-2s. So if you might, let's say you do pull out $150,000 of cash from your business every year, or a portion of that but your cash flow is very lumpy and you can't actually get into a W-2 that you can pay on a biweekly or twice a month basis. You can do it once a month, that's fine, but you actually have to live off of the income, and then you're constantly doing owner's draws or funky stuff with your business because you weren't prepared. That's a red flag to me. So in that sense, I don't recommend it until that cash flow is very consistent. Now, the other issue is partnerships. So what a lot of people don't understand, and again, please, tax people, correct me where I am wrong. Please talk to your tax advisor, not my expertise. But in S-corp, if you are taking owner's draws, which are considered dividends for an S-corp, it has to be proportional to the percentage that you own. So I can't just go take $20,000 out of an S-corp without my partners taking the equal amount in their equity. And that can be an amazing thing. So I recommend it for partnerships where there's any confusion on what people should make. And then you can mess with the W-2 salaries commensurate to how they're working in the company, but the dividends have to be equal to the percentage of equity. So that can be an amazing thing. That's one of the pros, but it's also one of the cons because it confuses people. It's like some people are using their LLC as their personal bank account. If you're doing that, don't become an S-corp because you can't do that anymore. And I don't think you should do it in the first place, but it will cause a lot of issues. So, and then the other piece that a lot of people don't realize is that filing an S-corp return is more expensive than filing an LLC return. Filing an LLC return, if you're a partnership, you have to do a K-1. If you're a single member LLC, it's just filing on your personal taxes. Much cheaper to do it that way. And S-corp is more expensive and more paperwork and more tracking. And there's different ways that you can deduct. So again, I'm not going to get into that into this video, but it's not the same as an LLC, either single member or partnership. And that can trip people up. They think, oh man, I'm just going to save $15,000. Yeah, but you're also going to spend, I don't know, probably like maybe if it's $1,500 for a personal return, $2,500 for an S-corp return. Every year, you're going to have to put yourself on payroll and pay payroll fees. You're going to pay payroll taxes as you go, which can help with quarterly taxes. So there's pros and cons, but your cash flow is going to look really different. And so not being prepared for that or not having a strategy around that can be really tricky and really hard. So that's where we're going to end on the S-corp thing. I do want to touch on the C-corp. So you can also become a C-corp. I think there's a huge benefit there. I think one of the things that trips people up between S-corp and C-corp is just the tax deductions. Again, I don't want to talk too much about that, but there are benefits to it. So if there's any struggle there, talk to a tax person, because sometimes you really should become a C-corp versus an S-corp, depending on how you want to live and how you want your business to run. So one thing you can do on a C-corp, you can't do on an S-corp, is you can have company cars on your C-corp. You cannot have them on your S-corp unless your business requires a vehicle. So something to keep in mind. That's my overview. So be cautious with that S-corp. It's a lot of branding and marketing around it, which is, they're great at doing that. But please talk to a tax firm. It's the right thing for you at your stage, and have them do some calculations and then have them look at the overall cash flow of the business. I, as a CFO, am going to look at the cash flow. I am not too concerned with the entity. We're also going to prepare you to save for taxes, whether you're an S-corp or an LLC. And so in my mind, the entity type doesn't matter. It's something that we will say, hey, you're at a point where we're going to have you go talk to a tax person. Most of our businesses are well above that threshold. And so it's very clear to say, hey, S-corp or C-corp or LLC, and we can kind of excuse me. But if you are at all confused, please reach out to my team or your personal tax person. So thanks for being here today. I am Natalie Cook with Finance Fight Club, here to fight for your financial future in your business. Thank you.